If you think putting your money into the S&P 500 is the safest and smartest way to invest, just hold on a second. In today's video, we're going to dig into how the S&P 500 actually works, how a handful of companies called the Magnificent Seven are dominating this index, what the AI boom and the dot-com bubble have in common, why and how I'm changing my own investing strategy, why global diversification matters more than ever, and finally, the biggest mistake investors make when the market drops. By the end of this video, you'll have a clear picture of whether just buying the S&P 500 is really enough anymore. And before we get into it, this video is for educational purposes only. It is not financial advice, so please do your own research or talk to a qualified advisor, because everyone's financial situation is different. Let's start with the basics. The S&P 500 is an index of the top 500 largest companies in America. Think Apple, Microsoft, Amazon, and it represents roughly 80% of the entire U.S. stock market. But here's something a lot of people miss. It's not an equal weight index. That means every company doesn't get the same slice of the pie. It's market cap weighted, so the bigger a company is by value, the more weight it carries in the index, and smaller companies barely move the needle. Historically, the S&P 500 has returned about 10% annually over the long term, which is why it's been considered a strong investment for decades. That's exactly why the advice has always been simple: just buy the S&P 500 and forget about it. This is where things get interesting, though. The Magnificent Seven refers to 7 companies: Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, which is Google, and Tesla. According to the latest 2026 data, these 7 companies alone now make up roughly 34 to 35% of the entire S&P 500. Think about that for a second. Just 7 companies out of 500 control more than a third of the index, while the remaining 493 companies together make up only about 65 to 66%. And this number didn't happen overnight. Back in 2015, it was just 12.4%. By 2022, it had climbed to 21.6%. And now in 2026, it's hit 35%, which is a historic high. We've never seen concentration like this before. So when you buy the S&P 500 thinking you're diversifying across 500 companies, in reality, about a third of your money is sitting in just 7 tech stocks. A big reason behind this is the AI boom. Companies like Nvidia are making AI chips. Microsoft and Google are pouring trillions into AI, and investors are so excited about it that valuations have shot through the roof. Here's the problem, though. When one group of stocks becomes this dominant, it drives the index's returns, but it also becomes the index's biggest risk. If the Magnificent Seven performs well, the S&P 500 goes up. But if even 1 or 2 of these companies fail to meet growth expectations, the entire index can drop, even if the other 493 companies are doing just fine. This actually happened in 2025, when a MIT report suggested that AI investments weren't producing measurable returns yet, and stocks like Nvidia and Microsoft dropped almost immediately. That shows just how sensitive the market has become to this small group of companies. This pattern isn't new, by the way. Back in 2000, during the dot-com bubble, the exact same thing happened. People were throwing money into anything labeled an internet company, valuations became completely unrealistic, and then the crash came, wiping out life savings for a lot of people. Now, I'm not saying we're definitely in an AI bubble or that a crash is guaranteed. Nobody can predict that with certainty. But there's actually some good news, too. By the end of 2025, some data showed the market's breadth was starting to improve. By September, about 59% of the S&P 500's returns for the year came from companies outside the Magnificent Seven, which used to almost entirely drive returns on their own. That's a healthy sign, but overall concentration risk is still historically high, so caution still matters. So what am I actually doing differently with my strategy? I'm not pulling out of the S&P 500 completely, it's still a core holding for me. But there are 3 things I'm doing. First, I'm consciously tracking my exposure to the Magnificent Seven, so I actually know how diversified I really am. Second, I'm looking into equal-weight S&P 500 ETFs, like the Invesco S&P 500 Equal-Weight ETF, known as RSP. In a fund like this, every company gets the same weight, whether it's NVIDIA or a much smaller company, which gives you genuine diversification. Some investors are also looking at value-focused funds, like the Vanguard Value ETF, which doesn't hold any Magnificent Seven stocks at all and offers a similarly low expense ratio. Third, I'm putting a portion of my portfolio into global and international stocks, so I'm not relying so heavily on U.S. tech. Here's the thing to understand. When you only hold the S&P 500, you think you're diversified. But when more than half the index's movement is coming from just 7 to 10 companies, real diversification is a lot thinner than it looks. A lot of analysts are now saying the S&P 500 is losing its distinctiveness because its movement is starting to look almost identical to the NASDAQ 100, which has always been tech-heavy. So people who think holding both the S&P 500 and the NASDAQ gives them diversification are actually holding a lot of overlapping companies in both places. That's exactly why I'm shifting toward global stocks. Outside the US, in Europe, Asia, and emerging markets, there are strong companies that perform independently of US tech. When the US market drops, that doesn't necessarily mean those markets drop too. This is really about breaking out of home bias. A lot of investors only invest in companies from their own country, but true diversification only happens when you diversify geography too. I'm not going to share my exact portfolio split here as financial advice, because that's a personal decision based on my own risk tolerance. But generally, the approach is a core position in U.S. total market or equal weight exposure, a portion in international and global stocks, and the rest in individual conviction picks or bonds, depending on your age, goals, and risk appetite. There's no one-size-fits-all formula here. Decide based on your own situation or talk to a licensed financial advisor. And finally, the most important thing. Whatever strategy you choose, panic selling is the biggest mistake you can make. When the market drops and people sell out of fear, those are the people who miss out on long-term returns. Market history shows that recovery has followed every crash, and the people who stayed patient are the ones who came out ahead. So the bottom line is this: the S&P 500 is still a solid investment, but before you blindly set it and forget it, understand exactly what you're actually invested in. Diversification isn't just about buying the S&P 500. Real diversification takes a bit more thought and planning. Just a reminder, this video is for educational and informational purposes only. It is not financial advice of any kind, and the numbers mentioned here are based on general market data that can change over time. Please do your own research before making any investment decisions, or consult a licensed financial advisor. If you found this video helpful, let me know in the comments how you're diversifying your own portfolio. See you in the next one.